Welcome to Talk Tickers. We cut straight through the noise of earnings calls.
And today, we're diving into Ball Corporation. They're, a major player globally in aluminum packaging.
Right, a big one. So let's get into their latest results. Q1 2025, how did they kick off the year?
Pretty strong start, actually.
Yeah.
Their comparable diluted earnings per share, that was up 12% compared to last year.
12% year over year.
Yeah, hit 76 cents, up from 68 cents back in Q1 2024.
Okay, that's a solid beat. What else stood out in the headline numbers?
Well, they've been busy returning cash to shareholders, too. About $708 million through buybacks and dividends leading up to the call.
Wow, okay. Significant return there.
And maybe more importantly, management sounds pretty confident. They reiterated their full-year guidance, expecting 11 to 14% growth in that comparable diluted EPS figure.
So holding firm on the outlook and overall business activity, shipments.
Global shipments were up too, saw a 2.6% increase year over year for the quarter.
Okay, so positive momentum on earnings, shareholder returns, and volume. Let's dig a bit deeper. What's really driving these better earnings?
Looks like a few things came together. They definitely saw higher volumes in several regions, which obviously helps the top line.
Makes sense.
Plus, they benefited from lower interest expenses. And it seems their cost management initiatives are, paying off.
Right. Now, didn't they sell off their aerospace business recently? That must have created some headwinds.
It did, yeah. That sale, plus some lower interest income, did act as a drag on earnings.
Yeah.
But those positive factors, the higher volumes, lower interest cost control, they pretty much managed to offset those headwinds. So even with that big portfolio change, they still deliver that earnings growth.
Okay, interesting balancing act there. Let's zoom in on the different regions. How's the picture globally? Maybe start with AMIA, Europe, Middle East, Africa.
Yeah, AMIA showed strong volume growth. And what's really driving it, according to them, is customers making a clear shift towards aluminum cans.
A substrate shift, really.
Seems like it. And that translated into a 13% jump in comparable operating earnings for AMIA. It's not just like a small trend, looks more fundamental. Sustainability, recyclability, all that seems to be playing a role.
So is that kind of growth sustainable itself in AMIA? What's the outlook?
They're expecting mid-single-digit volume growth there for the rest of 2025. One thing they noted is that supply in Europe is actually getting tighter.
Oh, really? Capacity constraints?
Potentially. They are investing, though, putting in new lines in existing plants. Czech Republic and near London. And they hinted at maybe more investment needed in Europe down the line.
Okay, keep an eye on Europe. What about South America? Heard that was looking good.
Yes, South America was quite strong. Volume growth actually beat their own expectations across the board there.
Better than expected. Nice.
And that really flowed through to the bottom line. Comparable operating earnings jumped 25%.
25%, what's behind that?
Seeing recovery in places like Argentina and Chile. Combine that with expected growth in Brazil, and they now think South America's volume growth will actually come in above their long-term target range of 4-6% this year.
That's impressive, especially for some of those markets.
Okay, let's bring it back home in North America. How did things look there?
North America actually returned to volume growth, which is, pretty good considering they had a tough comparison year over year, and the economy is putting pressure on consumers.
So growth despite headwinds. How much growth?
Comparable operating earnings were up 2%. And the growth seems to be coming mostly from energy drinks and non-alcoholic beverages. That helped offset some weakness they're seeing in the mass beer category.
Okay, shifting consumer tastes there. What about those tariff concerns we've been hearing about? Did that cause any pull forward of orders?
Management seems to think any pull forward was minimal, not really a major factor in Q1.
And their outlook for North America overall. They still sound confident they can deliver volume growth that's, in line with or maybe slightly ahead of the overall market for the full year.
Got it. Are they seeing any impact from issues facing brands popular with Hispanic community? There's been talk about that.
They said they're monitoring it closely, but so far they haven't seen a significant hit to their volumes from that specifically.
Okay. And quickly, the personal and home care side. Aerosols.
That also did well. Delivered mid-single-digit volume growth in Q1. And they actually expect that segment to grow above its long-term range for the full year 2025.
So it seems like broad-based strength across the different segments in Q1.
Yeah, generally a positive start across the board.
Okay, let's pivot to the financials then. What are the key targets and metrics they've laid out for the rest of 2025?
All right, looking ahead, net debt to comparable EBITDA, that key leverage ratio, They expect that to be around 2.75 times by year end, which, sounds pretty manageable.
2.75 times.
Okay.
And shareholder returns. You mentioned the Q1 activity.
They plan to keep that going. They're targeting at least $1.3 billion in share repurchases for the full year. And they've already done over half of that $651 million was completed already.
Okay, that's a serious commitment to buybacks. What about investing back into the business? CapEx plans.
CapEx is expected to be a bit below their depreciation and amortization, somewhere in the $600 million range.
$600 million.
Yeah, and they expect that spending to ramp up more in the second half of the year. A lot of that is tied to the new facility they're building in the Northwest.
Right. Any other key financial goals?
A big one is they're aiming for comparable net earnings to basically equal their adjusted free cash flow for the year.
Okay, earnings quality focus there.
Exactly. And just a few other housekeeping items. The rest of the tax payment from the aerospace sale, that's expected to be paid this year.
Got it. Tax rate, interest expense.
Full year effective tax rate on comparable earnings, they're projecting slightly above 22%, and interest expense for the year around $280 million.
Okay, and corporate costs.
Adjusted corporate undistributed costs, expected in the range of $150 million. And yes, they did declare the regular quarterly dividend as well.
All right, so a lot of moving parts financially, but it sounds like they have a clear roadmap. What about the bigger picture? Strategy, market view?
Strategically, the focus seems very much on operational execution, disciplined cost management, efficiency, productivity. That's the mantra.
Standard stuff, but important.
Absolutely. They acknowledge the volatility out there, emerging markets, geopolitics, tariffs, but they express confidence. They feel the business is resilient, defensive, and they've worked to strengthen the balance sheet proactively.
You mentioned initiatives, something called Ball Business Systems. What's that about?
Yeah, it sounds like their internal program for rolling out standardized processes, best practices across all their plants, kind of an ongoing efficiency drive.
And is it working?
They say it is. They're already reporting improvements, better safety, better quality, mentioned hitting record production weeks and even days in some plants during Q1 because of these systems.
Okay, so tangible results there. Anything else in the strategic front?
Well, they're focused on the usual long-term stuff, securing contracts, continuing to deleverage where appropriate, and optimizing their plant footprint, making sure they have the right capacity in the right places.
And didn't they do something with their aluminum cup business?
Yeah.
And acquire a plant?
Right. They formed that Oasis Venture Holdings for the cups, where Ball is now a minority partner. And yes, they bought Florida Can. That seems aimed directly at addressing some tight supply, especially for certain can sizes in North America, and giving them needed capacity, particularly for peak season. They said it's already integrated and running.
So adding capacity strategically, and overall, how do they see the future for aluminum packaging? Still bullish.
They're very much so. They really believe aluminum packaging will continue to outperform globally.
What kind of growth are they expecting overall?
They're forecasting global volume growth across all their businesses in the 2 to 3% range for the year, which they noted is basically in line with or even slightly ahead of the targets they gave at their investor day last year.
And regionally, you mentioned AMI before.
Yeah, AMIA, they expect mid-single-digit volume growth there, really driven by aluminum's advantages and the fact that it still has lower penetration compared to, say, glass or plastic in some European markets.
Makes sense. North America, we talked about volume returning to growth. What about margins there? Can they sustain them with cost pressures?
Yeah, maintaining North American margins is definitely a focus. They talked about finding more efficient routes to market with their big CPG customers. They acknowledged the affordability pressures consumers are facing.
So how do they plan to hold the line on margins?
Primarily through those efficiency gains. We talked about the Ball Business Systems and optimizing their footprint. They expect to maintain current margin levels that way.
Any specific product areas they see growing in North America?
They highlighted opportunities in specialty cans like the 12-ounce sleek cans, 7-ounce cans. But interestingly, they also mentioned a potential comeback for the standard 12-ounce can, maybe driven by affordability needs, particularly in beer.
Back to basics, potentially. And Latin America sounds like a continued bright spot.
Definitely. Very positive outlook there. The recovery in Argentina and Chile, plus Brazil, should drive growth above their long-term target this year. And they think that could even extend into 2026.
And Europe, beyond the near-term tightness, long-term.
Huge long-term opportunity, they believe. Again, driven by that substrate shift from glass to aluminum. But they stress the need to be careful and methodical with capital spending there because building new plants in Europe takes time.
Right, longer lead times. Okay, so pulling this all together for our listeners, what are the main takeaways from this Ball earnings call?
Well, I think it shows a company that's managing its costs effectively and navigating what's definitely a complex global environment, right? With tariffs, economic uncertainty,
Yeah, lots going on.
strong shareholder returns, that commitment to future buybacks and dividends that's likely attractive to many investors. And the regional details, they give you real insights into, consumer behavior in different beverage markets.
And strategically.
The focus on operational efficiency, those targeted investments like Florida Can, the Ball Business Systems, it all points to a long-term perspective on growth and profitability. And their comments on tariffs, the regional outlooks, that provides valuable context for understanding the near-term challenges, but also the opportunities.
Okay, solid summary. That brings us to our This Is Not Financial Advice segment. Time to spin out an outrageous but plausible trade idea based on what we've heard.
All right. So we talked about the tightening supply in the European aluminum can market, right? And Ball is investing, but maybe cautiously.
Yeah, sounds like demand might be outstripping supply a bit.
Exactly. So here's an idea. Instead of betting directly on Ball or another can maker, what about looking at a European company that makes the machinery used to produce aluminum cans?
Ah, the picks and shovels play.
Precisely. If supply is tight and can makers like Ball and potentially others need to expand capacity, the companies providing the can making lines, the technology, they could see increased demand. It's a way to play that European theme indirectly.
Interesting angle, focusing on the equipment suppliers. Okay,
Yeah.
What's idea number 2?
Idea 2 relates to South America. We heard Ball expects growth there to exceed its long-term targets, driven by recovery in places like Argentina and Chile, plus growth in Brazil.
Right, a positive outlook for a region that's often volatile.
So the outrageous but plausible idea here is maybe looking at a basket of consumer discretionary stocks, specifically in Argentina and Brazil. The thesis being, if Ball is seeing signs of economic recovery strong enough to boost beverage can demand significantly, perhaps other consumer-facing sectors in those countries could also benefit as conditions improve.
A broader bet on South American consumer recovery, using Ball's outlook as a signal.
Yeah, leveraging their specific insight into a wider regional play. Again, highly speculative, depends on that recovery really taking hold.
Definitely speculative. And remember, everyone, these are just thought experiments, absolutely not financial advice. Do your own research.
Absolutely. So wrapping up on Ball. Q1 looks like a solid start to 2025. Performance is strong in key regions, clear focus on shareholder returns, and they're working hard on operational improvements.
Seems like they're managing the global uncertainties pretty actively.
Yeah, they seem confident they can hit their targets. But it leaves you wondering, right? That European supply tightness, how might that ripple outwards? Could it create other winners we haven't thought of?
And that South American recovery, if it holds, what other downstream companies beyond just consumer stocks might benefit? Lots to think about there.
Definitely. Let us know your thoughts. And one last time, nothing we discussed today constitutes financial advice. Always do your own thorough research before making any investment decisions.